Share market returns moved into negative territory for the second consecutive month, and while they were not as severe as those that we saw in August, it was nonetheless another challenging month for investors. America's S&P 500 index was one of the better performers, falling by 2.6% in local currency terms over the month. The UK's FT 100 index was not far behind, falling by 3%. In Europe, returns were a little worse, with the German and French markets falling 5.8% and 4.3% respectively. In Asia, Japan's Nikkei index was down by 8%, while the Hang Seng index in Hong Kong fell 3.8%, its fifth consecutive negative monthly return. Elsewhere in Asia, China's Shanghai market fell another 4.8%, which looks relatively modest compared to its 12.5% fall in August. The weakness in overseas markets spread to Australia, where the ASX 200 accumulation index returned -3%. All but two of the industry sectors lost ground, with resource-related companies amongst the worst performers as concerns grew that commodity prices have further to fall. BHP Billiton was down 11.8% and Rio Tinto fell 3.4%. For the second month in a row, energy was the weakest sector, falling by 12.2%. While further oil price weakness didn't help, stock specifics contributed most to the negative return, in particular Santos and Origin Energy, who have high levels of debt at a time when earnings are lower. Woodside Petroleum's share price was also under pressure following its takeover offer for Oil Search. Market returns were mixed in the year to September 30. The S&P 500 index was down 2.6% in local currency terms, while in the UK, the FT 100 index fell 8.5%. Returns in Europe were better, though unspectacular, with the German and French markets returning 2% and 0.9% respectively. Japan's market continues to outperform its global peers, with the Nikkei index rising by 7.5% in September. However, Hong Kong's Hang Seng index fell 9.1%. As for the Shanghai Stock Exchange, it was still up by 29.1% in the year, despite the pronounced weakness and volatility in recent months. Australia's ASX 200 accumulation index fell 0.7%, and this was again due largely to the price weakness of resource and energy companies. Markets have been uncertain about the outlook for global growth, and perceptions have been changing almost on a daily basis. As we saw in August, slower growth by China's economy was the dominant influence on markets in September. Recent data did little to alleviate those concerns. For example, a recent Chinese manufacturing activity survey fell to its lowest level since early 2009. The possibility of slower growth in China accentuated concerns about other emerging economies, particularly those with commodity dependence. Comments by the US Federal Reserve following its decision to leave interest rates unchanged did little to ease concerns about the health of the global economy. In its statement, the Federal Reserve cited a more uncertain global outlook and heightened concerns about growth in China as reasons for a cautious approach to raising rates. There are a number of reasons to be cautious about the outlook and return potential from here. The performance of China's economy and the degree to which it is slowing is an ongoing source of uncertainty. As it is Australia's largest export market by far, what happens in China has direct consequences for our terms of trade, currency, and the economy overall, at a time when prices for our major exports, such as iron ore, have fallen and the peak of the resources capital spending cycle is behind us. The impact of what happens in China is also relevant to our other trading partners, such as Japan and South Korea, and the global economy in general. However, there are some positives that may have been overlooked during the recent market weakness. Firstly, the US economy continues to perform well. A recent report by the Commerce Department said the US economy grew by more than initial estimates in the second quarter, leading to an upgrade to the annual growth rate from 3.7 to 3.9%. Although it is worth asking, how much better could it get from here? Secondly, growth in the other developed economies, such as the Eurozone and Japan, is either stable or improving, albeit very slowly. Thirdly, the substantial fall in the price of oil, combined with the quantitative easing programs in the Eurozone and Japan, will benefit consumers and help support global growth. And finally, China's economy is still growing, perhaps not by as much as markets were hoping for, and the Chinese authorities have a good track record in responding robustly to difficult economic circumstances when required.